Okay, welcome back to chapter 10, which is about property, its basis, and not taxable exchange. We are going to talk about good stuff like realized gain or loss, initial basis of the property, recognized gain and losses, wash sales, sales between related parties, qualified small business stock, like-kind exchange, sale of principal residence, involuntary conversions, and investment in qualified opportunity fund. Some of them are really kind of common. Some of them you may never see it anyway. So we try to cover as much as we can. The learning objectives are here provided to you in this chapter. And let's go next page, see if we can get something more. Yeah, here, realized gain or loss. So realized gain or loss happens when taxpayers sell, exchange, or otherwise dispose a property. That means if you have a property, even though it has been appreciated in the value, you don't pay any taxes until you sell it. That at that moment you will realize the gain or possibly loss from it. But as long as you keep it, there is no gain or loss to recognize. So let's say I have a stock portfolio. Stock prices are down right now. If I sell it, I will realize loss. If I don't, then it's okay, I just keep it. Maybe a few months later, the price will appreciate. If I keep it, nothing happens. If I sell it, I will realize gain or sometimes loss, depends on the price that I'm selling it. So IRS doesn't ask you to do anything until you sell that property. They also occur when the government exercises its rights to take the taxpayer's property in exchange for fair compensation. They call that condemnation. That means they take your property for a price that they say this is the fair market value. If that happens, again, there is a gain or loss realized because of that. When the amount realized from the transaction exceeds the basis, or so-called adjusted basis, then that's a realized gain. And the reason we say adjusted basis because you might have a basis on a property, but when you depreciate that property, then you have adjusted basis because you're, depreciating the property, so the basis is going down. When the adjusted basis exceeds the amount realized, then you have a loss because of sale. So that's a very important word that says realized. Sometimes you have realized, but sometimes you also use the word recognized. Okay, so those are two different things. Realize, that means you already realized it. Now that it is realized, then you probably need to recognize it. Amount realized. So the amount realized equals the sales price minus selling expenses. Selling expenses includes like commissions, legal fees, escrow fees, any cost that relates to the sales. Sales price is the sum of the fair market value of the property, which includes cash and services received in return for the property given up. It also includes any debt that the taxpayers, the seller is giving to buyer. That means the seller of the property, if they owe something for that, any reason, and then the buyer says, I'm gonna pay you this much cash, plus I will take care of that loan myself. So the sales price is the cash and the loan that has been assumed by the buyer combined. Okay, so an example, Howard sells stocks for $12,000 cash plus a car valued at $5,000 fair market value. So Howard's amount realized is typically $17,000, not just $12,000 cash. Martha exchanged land for building that has a fair market value of $90,000. The land is subject to a $50,000 mortgage, which the other party assumes. So technically, Martha amount realized is $90,000 of fair market value of the building plus $50,000 mortgage that has been assumed by buyer. So that's $140,000 realized. And adjusted basis, what is adjusted basis? Adjusted basis is the initial basis in the property that you purchased many years ago, plus any capital additions, anything you added to it, minus capital recoveries. Capital recoveries are like depreciation, anything that you recovered from that property and you recognize expense for it. Okay, so what is capital addition? Includes costs incurred in transferring or defending title to the property. Let's say you have a property and then you get a lawsuit that that property, has some type of legal issues. You defend your lawsuit, you spend $10,000 to defend that lawsuit, and you are successful. In that case, that $10,000 goes at the top of the basis of that property. Also includes any commission and legal fees that you spend. Capital additions also include the cost of improvement that increases the property value, lengthen its useful life, or convert it to a different use. Improvements have a useful life that exceeds 1 year. Maintenance and repairs are not improvements since they are routine and recurring costs. So let's say you have a car. You spend $500 to change the tires and brakes. That's maintenance. You call it maintenance expense. You recognize it as an expense and you use it as a deduction for your tax return. The car, you bought it for $10,000, but let's say a year, 2 years later, you add a brand new transmission. That's $3,000 transmission. So that is an addition because that will increase the life of your property. So now your basis is $10,000 original plus $3,000 new transmission. So your basis is $13,000. Now, if you sell your car at that moment, let's say for $14,000, so your adjusted basis is 13 minus $14,000, that's $1,000 capital gain. Now that capital gain is a long-term because you kept the car more than a year, so that's a long-term capital gain. If you kept the property less than a year, it's short-term. So the improvement has to have more than 1 year useful life, like transmission in a car, like a new engine, a tow hitch on the car, something that kind of worked for a long time. Examples of improvements are like installing roof, furnace in a building, putting up a fence, paving a driveway, rebuilding a car engine, landscaping, building recreation room in an unfinished basement, paying special assessment for sidewalk, roads, etc. Adding a room into a house or other building, those type of things are all improvement. So years ago, Lloyd paid $125,000 to buy a house. Over the years, Leroy has paid $35,000 to remodel the kitchen. Okay, $5,000 to install a wooden fence, $3,000 to reshingle the roof. He also has paid $13,800 to keep the property in good condition. Lori's adjusted basis in the home is the original cost plus the kitchen plus fence plus roof, but not maintenance. So he cannot say, oh, I paid for maintenance, my basis has to go up. IRS will not accept that as maintenance. Now, if it's a business property, you might deduct that maintenance as a maintenance expense. But if it's your own home, then nothing gonna happen to that $13,800. You just keep the property in a good condition, good for you. Yeah.
So like new floors, wood floors?
Wood floors?
Yeah, like new floors.
Yeah, floors are improvement. Yeah. But let's say you pay $100 a gardener to come and, every month to clean up your property. Let's say you paint it. That's maintenance. Let's say, small stuff. Those are maintenance. Those are nothing. But something that if you add it to that home, it's gonna add the value and it's gonna have a longer than a year life, then you can call it as, so you're better to keep all your receipts for all those improvements.
So we redid a room in a house and did the floor. Changed it to wood floors, we painted the wall, put new trim on top and bottom, and we see that. So the ceiling fan and floor will be all improved.
Yeah, ceiling fan and floor will be improvement. Paint will be nothing. So you cannot keep the receipt of paint $50, say, hey, my basis went up by $50 here, I painted my house or my room or whatever. But if you put ceiling fan, yes, you can keep that receipt because your basis goes up. Capital recoveries are a return of taxpayers' investment in property. They occur when taxpayers receive money or take tax deductions in connection with the property. Anytime taxpayers recover part of their investment in property prior to disposing of it, they must reduce the basis of the property accordingly. So if you receive money or doing recovery of a tax deduction, like a depreciation, those are recoveries. When property is damaged in a casualty, taxpayers reduce their basis in the property by amount they receive from the insurance company. So if the insurance company gives you $100,000 because of that disaster that happens, like hurricane or whatever, so your basis goes down by $100,000 because you receive money from insurance company. The same basis reduction rule applies to amount taxpayers receive from government in exchange for government rights to use the property. They call it easement. Easement, that means the government says, I need a road in between your, let's say, property, so public can walk through this road and go to the beach. That's an easement. Because public needs to have an access to the beach. Beach is not yours, the property is yours. But in between of this property and the other property in between, the government takes some part of it as an easement and opens that part as a sidewalk for public to go to beach. So if you receive any money because of that, then your basis goes down. Okay, so what else? We have few examples here. So let's read one of them. Several years ago, Ralph paid $120,000 for land. In the current year, Ralph receives $20,000 from government in exchange for the right to use part of land. Ralph must reduce his basis in land by $20,000. Although Ralph initially paid $120,000, but after receiving $20,000, his basis, adjusted basis now is only $100,000. You see, the depreciation is also included, including bonus depreciation or Section 179 expensing. Those are also recovery of your basis. Yes.
Is it always ideal or better for clients to try to increase their basis?
Yeah, you want, because if you have higher basis, then one day you will sell it and the difference, which is capital gain, will be lower. You will have less capital gain. So if you can have higher basis, that will be great. Yeah. But if you depreciate your property, then your basis keeps going down. That means one day, if you sell your property, then you have a big chunk of capital gain waiting for you because your basis is keeping going down every year you record that depreciation. And also, just so you know, we might get to that point. When you depreciate your property and then you sell it, the portion that you depreciated, it's not capital gain. Because capital gain, let's say long-term capital gain, has a very favorable tax rate, like between 0 to 20%. So government says, no, wait a moment, you depreciated that. Because you depreciated that and you take advantage of showing less ordinary income, and less ordinary income, that means you paid less taxes based on your tax bracket. And you might have a tax bracket of 37%. So that depreciation helped you to save on 37% tax bracket that normally you are taxed on. So you're not gonna, you have two types of things to calculate. What is my capital gain and what is my ordinary income based on my depreciation that I recaptured? We call it depreciation recapture. Depreciation recapture, that means you have to show that as ordinary income, not capital gain income. And the reason is because that depreciation gave you an ordinary income deduction item. So Jenny is also sole proprietor. During the year, Jenny placed in service equipment costing $24,000. She elects to expense the entire amount on Section 179. Jenny's adjusted basis in the equipment is 0. Therefore, the entire amount realized on the sale of equipment will result in realized gain. But this realized gain, again, it has to be calculated based on not long-term capital gain, because Jeannie deducted the basis using ordinary income deduction item, which calls depreciation. Okay, one more example. In 2014, Lee paid $62,000 for a building. He spent $10,000 in 2018 for new roof added to the basis. So it's important for you as a tax preparer to hold on to those basis information and have a very good documentation. You cannot ignore this stuff. Otherwise, later on, you get in trouble. And your client who you are prepaying taxes will get in trouble. In 2019, a federal disaster damaged the building. The insurance company paid Lee $20,000 for the loss. So that's a deduction from basis. Lee claimed a $10,000 loss deduction in her 2019 tax return for the unreimbursed portion of the loss. In 2022, Lee spent $29,000 to rebuild the part of building destroyed in the disaster. Over the years, Lee has deducted $22,000 for depreciation on the building. Lee computes the adjusted basis in the building as follows. So initial cost of building is $62,000, starts with the dollar sign. Then you go to the column next to the left. The first number starts with the dollar sign. You plus capital addition, which is improvement, $10,000. Okay, that's this one, new roof. Okay. And here also he spent $29,000 to rebuild the part of building destroyed. So he spent another $29,000 as addition. So total addition is $39,000. So far, it will be added to the basis. But Lee depreciated the property for $22,000 and got a benefit out of that. Insurance proceeds got another $20,000. Casualty loss deduction got another $10,000. So you got two times cash and one time depreciation. Add them up, total $52,000 will be deducted from the basis. So 62 plus 39 addition minus 52 cost recoveries, capital recoveries. The answer is $49,000 adjusted basis. So if this is your client, you have to make sure that the client has, and you have a good understanding of all these bases. Because this happens, your client buys a property today, and now we are talking about 10 years later, and all of a sudden it's sold, and then your client says, okay, do my taxes. What? Who has the record of last 10 years what happened, right? And if you don't have a proper documents of what happened, IRS might even decline anything that you say verbally and says, you know what, I don't take that. I assume your basis is zero, or I suggest use a basis whatever IRS suggests. So you don't have any records and you don't have a way to prove it. So when computing adjusted basis, you start with initial basis. The initial base of purchased property is the cost, including escrow fee, commission, whatever you pay. However, taxpayers can acquire property through other means, such as through gift, inheritance, and divorce settlement. Let's talk about property that you purchased. The initial basis of purchased property is the cost, whatever the taxpayer gives up to buy the property. Includes amount taxpayers borrow to buy the property. It also includes any cost incurred to obtain clear title, title insurance, escrow fees, everything. Sales tax, delivery, shipping, testing of the property. Let's say it's an equipment. You buy an equipment for $10,000. You pay $1,000 for shipping. You pay $2,000 for installation and testing. So the whole cost of equipment is $10,000 plus shipping plus testing. That's $13,000, and you have to document that. If you paid sales tax, that will be added to it. So real estate paying $50,000 cash, assuming $75,000 mortgage from the seller, and the property basis ends up to be $125,000. The cash plus mortgage assumed. So Kelly buys a machine for $10,000. She pays for $600 sales tax, delivery $400, and therefore the initial adjusted initial cost is $11,000. When taxpayer performs services in exchange for property, the initial basis in the property is the value of services the taxpayer includes in income. Let's say Sal received 10 shares of stock in exchange for services he rendered. The market value of shares is $300. Sal is taxed on $300 for his services. His initial basis in the shares is $300. So Sal has to show that $300 as income.
For the market value, is it the day he got it, what market value it's at that time?
Yes. On that moment, if you got something like shares, you document that. So he will be taxed on the $300 revenue that he earned, and also his basis on the stock will be $300. Now, if he sells that stock later on, if he sells after 1 year, then it will be, let's say, sells for $400, then it will be $100 long-term capital gain. If he sells it less than a year or less for $400, still it's $100 realized gain, but that's a short term. So bargain purchase or basket purchase, that's also important because so many times happens that someone buys something as a whole in a basket. So companies sells goods or other property to their employees for less than fair market value. Often employees tax on the difference between fair market value and the purchase price. In this case, the employee initial basis ends up the same as the fair market value of the property, since the initial basis includes amount taxed as income. If employee does not have to report any income from the bargain purchase, then the employee initial basis equals to the amount paid for the property. Let's see an example. So Morgan pays $60 for property from a company where he is an employee. So $60 for that property. The fair market value of that property is technically $100. Morgan reports $40 difference between fair market value and the purchase price as income on his tax return. In that case, the initial basis is $100 because he reported already $40 the difference as income. If not, then the basis will be only $60. That's what he paid. So it depends what Morgan is doing. Is he going to report the $40 as income or not? Most of the times they don't. So if they don't, then the basis is $60. And imagine as soon as he buys it for $60, a few weeks later he sells it for $100, fair market value. So the difference is $40 short-term capital gain. Basket purchase is the purchase price multiplied by fair market value of the property over fair market value of all properties. So whatever the property has a fair market value divided by combination of fair market value of all the properties in that basket gives you a ratio. So purchase price times that ratio gives you initial basis on that specific property. But in the basket, you have a lot of other properties too, but you bought it in one piece. For example, Devon pays $90,000 for a land and a building. This is a very common situation. You buy a building, it comes with land, right? So you paid $90,000 for land and building. At the time of purchase, the fair market value of land and the building are $80,000 and $40,000. So he got a good deal, right? He got a good deal. He got a good deal because he paid only $90,000. But if you look at the value of it, it will be 80 plus 40. That will be 120. So Devon's basis in the land equals to what? 90 out of, land is, land and building are 80 and 40. So land is 80, building is 40. Okay, so land is 80, building is 40. In regards to land, 80 out of 120 gives you a ratio. Whatever that ratio is, multiplied by basket purchase of 90, then land value is $60,000. That goes in your cost basis. So his basis in the building equals to 30,000, which is 40 out of 120 multiplied by $90,000 basket purchase. Then a taxpayer receives property from a spouse. One more thing, that in case you buy a property, you get a property tax report that you have to pay property tax, right? As soon as you receive your first property tax bill, if you look inside, it will tell you that how much did you buy the property, what portion is land, what portion is building. You can use that as a form of document to say, okay, how much is my land and how much is my building? And you can depreciate only the building, not the land. So you have to know how much building is. You cannot just depreciate the whole thing. You depreciate the land and just the building, not the land. So when a taxpayer receives property from a spouse, the spouse adjusted basis in the property carries over to taxpayer. So whatever the spouse adjusted basis is, it will carry over. No tax consequences happens when property is transferred from one spouse to another, or because of divorce settlement. So as a part of divorce settlement, Drew transfers to April title to his mountain cabin. Drew paid $80,000 for cabin 6 years ago. Over the years, he spent $23,500 on improvement to the cabin. At the time the transfer, the cabin was worth $240,000. April basis in the home equals to Drew's adjusted basis in the home, which is $80,000 on initial purchase price plus improvement additions, $23,500. So that will be $103,500 adjusted basis, which will carry forward to April. If April were to sell the home for its current fair market value of $240,000, then her realized gain will be $240 minus $103,500, which is $136,500 long-term capital gain. And also, the timing is also carrying over to April. Make sense? Even April gets that and sells a month later, still it's a long-term capital gain because everything will transfer to April. Make sense?
Even though he bought it 6 years before the marriage, Now that she has it, those 6 kids are kind of like.
Yeah, all that time period will transfer to April. So April gets the adjusted basis and April gets the time frame to recognize long-term capital gain. Okay, inherited property, when a person dies, an executor is assigned to distribute the decedent's property, known as estate. Before distributing the estate to the decedents, heirs, the executor first computes the estate tax due. Estate tax is computed on the total fair market value of decedent's estate, net of liabilities. Estate tax is due only when value of estate exceeds a certain amount. So the executor will take care of paying taxes for the property that has been increased in fair market value before the distribution of the property to decedents. So decedents, they don't pay for it. If you inherit something, normally the tax will be paid by the state. We might have examples. In computing the estate tax, executor usually values the estate on the date of decedents. So we have two options here. So be careful to see and understand both of these. So in computing the estate tax, the executor usually values the estate on the date of decedent. So it's very important to know when is the date of death. We call it DOD. An heir's initial basis in the inherited property is the property's fair market value on the date of death. Why is fair market value on the date of death? Because the executor already paid the taxes that was due between the adjusted basis and fair market value. So the executor of the state will pay all that capital gain. And when you get that property as inheriting that property on date of death, whatever the fair market value is, there you go. That's your basis. However, under certain conditions, the executor can elect, this is option 2, to value the estate 6 months later, known as alternative valuation date, or AVD. So when you want to value the fair market of the property, the option 1 is DOD. Option 2 is AVD, alternative, which is 6 months later. When the executor values the estate on alternative valuation date, the heir's initial basis in the inherited property is its fair market value on alternative valuation date, or on the date it is distributed to heirs, whichever comes first. So if alternative valuation date 6 months later, if exactly on that date he gets the property, then that's the fair market value. If it was distributed after that, whichever comes first, we go with that. So if they get distributed between DOD and AVD, and they choose AVD, they go with the date that has been distributed, because that came first before AVD. So let's look at the example. I think it's a better idea. So Rhonda inherited land from her grandfather, who died in November of 2020. On that day, the land was valued $45,000, DOD. So DOD was $45,000. On May 5th of 2022, its value was $42,000. The land was distributed to Rwanda on July 2nd of 2022. Rwanda basis in the land is 45,000 if DOD is used to value the grandfather's stake. If the AVD is used, Rwanda's basis is 42,000 since AVD occurs before the date of distribution. So that's November, December, January, February, March, April, May. Here should say, let's say, okay, imagine the date of death was 2021, okay?
Oh,
Yeah. Imagine that's a typo. So its date of death is November 5th of 2021. On that day, DOD is $45,000. That's DOD. On 6 months later, on AVD, value was 42,000, and that's AVD. The land was distributed to Rwanda on July, even a month after June, July, 2 months after almost, 2 months after AVD. So Rwanda's basis in the land is 45,000 if DOD was chosen. If AVD is chosen, then Rwanda basis is 42,000 since AVD happens before the date of distribution. So now we have just to see which date has been chosen by the executor, DOD or AVD. Same fact as example 13, except that land was distributed to Rwanda on March, and March is before AVD. Okay, that's before AVD. When the value was 43,000 on that day. If DOD is used, the value as a value, then it will be 45. If AVD is used, it's not gonna be 42. I know AVD is 42, but it got distributed before that, so we go with whichever is first, which is 43,000. Make sense? And again, you have to have documentation on all of those situations. In 2010, there was no state tax and modified carryover basis. Rules could apply to property inherited from descendants dying in 2010. Under the modified carryover basis rules, the decedent adjusted basis in the property, not its fair market value, is used as the straight point in determining heirs basis in inherited property. So under the modified carryover basis, the decedent's adjusted basis, whatever it was in the property, is used to as a starting point for the heirs basis. Those interested in learning more about the modified carryover basis, which is it's related to 2010, then you have to read this publication. But that's only in 2010. But other than that, this is what we have right now, DOD and AVD. And if you choose AVD, then whichever comes first, distribution first or AVD first. Gifted property, two set of rules apply to property received as a gift. One set applies when, at the time of the gift, the fair market value of the property is less than the donor's adjusted basis in the property. So imagine the property basis is $10,000, and at the time of gift, the fair market value of property is $8,000. So it's less, right? Another set applies when fair market value exceeds the donor's adjusted basis in the property. Let's say, again, the adjusted basis is 10,000, but fair market value at the time of gift is 12,000. So this is the scenario number 2. So which one is gonna be your adjusted basis? So let's go with the first one, which fair market value is less than donor's basis. When at that time of the gift, the fair market value is less than the donor's adjusted basis, the donor's basis in the property is not known until the donee, the person who receives the gift, disposes of the property. So technically, if the fair market value at the time of donation is less than adjusted basis, then at that point, you just document that, and you don't know what the basis is until you sell it. Upon disposal, the donees compute gain or loss first using the fair market value of the property at the time of the gift, which was lower, as initial basis. If loss results, then the donor's initial basis is the fair market value at the time of gift. If a gain results, then the donor's basis usually is the donee's initial basis. However, if second calculation does not result in a gain, then there is no gain or loss, and the donor's adjusted basis equals to amount realized. So let's look at an example. So don't worry, just relax here. Joan receives stock valued at $15,000 as a gift. The donor paid $20,000 for that stock. Joan later, so the fair market values was 15 less than donor's initial basis, right? Adjusted basis was how much? 20. But at the time of gift, the fair market value was lower than basis. So we don't know till we sell that stock one day. Joan later sells the stock for $23,000. Since Joan sells the stock for more than donor's basis, her basis in the stock is 20. Make sense? Because he sold more than donor's basis. So how much is the lowest tax? Lowest gain. Lowest gain is using 20 minus 23 is 3,000 gain. Yes.
Is it possible to not know, to be gifted something and not have that information, like not know when they bought the stock or at what price?
If you get such a thing, who gave it to you? You have to ask him.
Well, they're dead. I'm just saying.
Yeah, you have to
What if you
investigate.
gifted something from a relative and you don't have, like my grandmother gifts me,
Like what?
or she gifted me stock. Is it
Then you have to go through the
executor?
portfolio. She has a portfolio reporting every year, right? And through the donation,
It seems like that could be hard to find, but
yeah, through the donation, because the stock is in his or in her portfolio. You cannot take over the portfolio unless you have a state who is doing that.
Yeah.
Someone is giving you. Who is this? Who is that executor?
they have that information.
Executor has the information because executor is talking with the, let's say Robinhood. Executor is talking with Robinhood saying, hey, Robinhood, this guy is dead. And this stock has to go to someone else. What's the basis? And Robinhood will send a report, says, hey, this stock has been purchased many years ago. And this is the basis.
An executor, do you automatically get the ability to talk to all their accounts then?
Executor is responsible to figure out what is the basis of every single thing that dead person has, to know the initial basis, and then says, okay, I'm gonna, let's say, that's an inheritance, it's not a gift, okay? And then inheritance, before distribution of that property, the executor has to figure out the capital gain, pays the tax to the government, and then you get the property. And I just covered that. That's either based on DOD or based on AVD or the distribution, whichever comes first.
So if a property is, let's say, handed down to one person and they figure out the basis based off of DOD, and then that person dies and hands it down, they go from the second person's basis for the third.
Yeah, you go step by step. You say this guy, first guy died based on DOD. This is the fair market value. Okay, let's say, for example, the basis is $10,000, DOD is $15,000. So 10 minus 15 is $5,000 capital gain. They pay the tax to the government. Whoever receives it now has $15,000 basis. Then he dies. Same thing. Okay, he dies. The basis is 15,000. DOD is 17,000. So 15 minus 17, that's $2,000 capital gain. The executor will pay the capital gain. And then whoever receives that now has a basis of 17,000. So it keeps going forward. Okay, so here was the idea is this. This is the way you can kind of remember it, okay? It says, if the fair market value is 15, which is below basis, and then he sells for above basis of 20, then the capital gain goes with the highest one. So the capital gain to become as small as possible. Because if you use $15,000 as a basis, then the capital gain will be $8,000. Government says, no, I don't want to give you that much hard time. So you use the initial basis of the donor, and initial basis of the donor is 20,000. 20,000 minus your selling price of 23, you have $3,000 capital. Same fact as example 15, except that Juan sells the stock for 13,000. Okay? Even below the fair market value of as a time of gift, which was 15. He sold it below that. So Juan sells the stock for less than 15 fair market value at the time of gift. Therefore, her basis in the stock is $15,000, and she is going to realize a $2,000 loss, which is 13 minus $15,000 basis. So when she is going to recognize loss, she is going to recognize the minimum loss possible. Got it? Minimum loss. So scenario number one, you have less than fair market value if the initial basis is higher. If you sell more higher than initial basis, the initial basis will be used to recognize as a small capital gain as possible. If you sell it below, let's say below that $15,000 value at the time of gift, then you recognize as a small loss as possible. So as a small gain as possible, as a small loss as possible. Yes.
For the donor, if the donor receive use the fair market value less than the base, then the donor should reply like 5,000 loss. The donor?
The donor recognized, no, because the donor gave it a gift. If you want to recognize loss, don't gift it. Don't gift it. Sell it yourself, recognize loss. Make sense? You cannot gift it and show, oh, you are such a nice person, and then go to IRS, claim $5,000 loss. Right? If you are such a nice person, then gift it.
Then the $5,000.
Then stop talking about it, right? Yes.
The $5,000, go to lower.
Go to where?
Go to lower.
Nowhere?
$5,000 just gone.
Yeah, it goes nowhere. Yeah, because you decide to gift. Don't gift. Don't gift and sell it yourself. Recognize $5,000 loss. Yeah. But if you decide to gift it to someone, then just gift it and don't talk about it. That's it. And the receiver of the gift now needs to compute what the basis is based on the future selling price. If you sold it in future, if it's a gain, recognize the smallest gain possible. If it's a loss, recognize the smallest loss possible. Now, there is one more, I think. Yes, here. Ready? This is situation 3 about the same scenario. Same fact as example 15, except that Juan sells the stock for 17,000. 17,000 is between the initial basis of 20 and the fair market value of 15 at the time of gift. So it's right in between. Okay? So when Juan uses the 15,000 fair market value, the loss basis, to compute her loss, she's going to have a $2,000 gain. When she used the donor's basis of $20,000 adjusted basis, then she has to recognize $3,000 loss. So whichever is going to happen. Therefore, Juan recognizes neither gain nor loss. Her basis in the stock equals exact selling price of $17,000, and there will be no gain or loss. Case closed. So if Juan sells it in between of fair market value of 15 and basis of 20, anything in between, it will be no gain or loss. But if there is a gain, it has to be the smallest. If he sells above 20, so 20 is the base. If he sells below 15, then 15 is the base. Got it? That was a lot of information, huh? And imagine how to explain it.
He don't know. If he didn't sell at the same year, next year or 5 years later.
That's why everything happens, you have to keep good record of it. And if you don't keep a good record of it, IRS will say, you know what? Your basis is 0. Whatever you sold it, all of it is capital gain. Case closed. And you say, no, verbally I can tell you exactly what it is. Verbally doesn't help. Unless IRS is really nice to you, it says, okay, provide me something in writing, and I will decide if you are doing a good numbers, giving me a good number, or you are trying to be smart. If you try to be smart, IRS will not accept it. So end of the day, it's better to keep your documents right and documented so you can argue every single situation. Yes.
So if a client comes in and they don't have records of that, and you still need to report it, what would you do?
One situation is you might put a number there and file your taxes. This is the number that you believe it is correct. and you write it down and you document it. And then you file your taxes, and then you cross your fingers. If no one audits you, then good to go. If they audit you, then they say, where did you get these numbers from? And if you say, you know what, honestly, I don't have anything. This is just based on the estimate that what I remember. And they said that's not gonna work because the numbers looks a little bit too much towards your benefit. So either we're gonna just ignore all your numbers, make the basis 0, or maybe we kind of be nice and give you a basis, but whatever we believe it might be correct. So they're gonna change that. But if they don't audit you and you slide through, then you slide through. That's why so many people prepare taxes, which is half of it is wrong and whatever. And if they don't get caught, they don't get caught. And IRS doesn't have time to go after everyone for every dollar, right? Overall, IRS wants to collect taxes. That's the whole purpose. So if they can, if the number is a little bit chunky, big fat number, and they say, you know what, raise flag. Send him a letter, let him provide us some documents. If not, then you will go through and nothing happens. God bless America. Okay, it's good enough for today. Next time we're going to continue on this chapter, and hopefully we can finish to some degree. I suggest read this chapter. See you next time.